Welcome back, everyone. This is theCUBE coverage here at the NYSE. I'm John Furrier, host of theCUBE. This is our East Coast studio. We've got Palo Alto and Silicon Valley, connecting Wall Street and Silicon Valley. All the tech coverage here on theCUBE, SiliconANGLE.com. For all the journalism, of course, theCUBE research. We're tracking all the top tech companies, biggest trends. And here we have David Shapiro, CEO of OpenVC. Great to have you on.
Great to be here.
So we were talking before we came on camera about your background at Goldman. Goldman's got the new look. Now you adopted that with your firm.
Very tech forward, founder.
I love the name OpenVC. It's the name of the firm. I love open ecosystems is all the rage. Again, it's connected now with generative AI. Venture capital used to be a cottage industry, hard to get into.
Right.
You guys are kind of democratizing that tracking. What does OpenVC do?
Well, you're exactly right in terms of democratizing, right? Venture capital and really private assets have been holdovers with respect to allowing the everyman or investors that have fee sensitivity or liquidity problems access. What OpenVC is doing is providing that access. We're doing it in two principal ways. First, we're working with ICE, which is actually one of our largest external shareholders, to create indices. Think the S&P 500, but for unicorns, right? Private companies that most people don't understand the value of, but would really like to if they're going to make investment decisions. We actually just in August launched the New York Stock Exchange Open Venture Capital Unicorn Index. It can be found where any, reputable indices are distributed. And two, in light of that access goal, we seek to create product and opportunities to track our indices, ultimately enabling retail contingent and, again, institutional investors with those fee and liquidity problems to access private assets.
So first tracking,
correct.
And then ultimately next step would be to open that up to more fund access or like an index fund, or how would you describe what happens next?
That's exactly right. So we believe that the wave of passive investing is going to take over private markets, right? Today, there really is no bulk player. If you want to go out and say, I'd love to buy growth equity as an asset class, you have to make specific decisions. You have to bet on industry experts. You have to, seek the alpha wherever possible. And that's very expensive.
Yeah.
And it's very limiting in terms of who can actually get into a Sequoia or an A16Z. And they do amazing work. We just believe that there should be a mass affluent everyman solution.
It's interesting. Everyone has the FANG or the Magnificent Seven, and they just ride that wave. And in this market, it's been a good formula.
Very good.
On the private side, you don't have a lot of data because they're not yet public.
Correct.
But yet there's a kind of a trading system going on the private side. And so valuations are elusive. It's what you say they are, right? It's like, the old expression to the CFO, what's your valuation? Whatever we say we are. Obviously, I'm oversimplifying and a little hyperbole there, but you take companies like Databricks, Stripe, they could have been public companies, years ago.
Correct.
Okay, Snowflake's public, Databricks is still private. That's what's the comp? I mean, this is with a nuance that you get into in these stocks. It's like, okay, we know there's liquidity.
Right.
I see trading all the time on Databricks.
Right.
How do I get in on that?
Right. And that's the big question, right? Companies have been staying private longer and longer, right? Whereas Stripe and Databricks, both fantastic companies that would likely be in, either the Russell 2000 or S&P 500 should they list, have not. And ultimately what that does is it locks out folks who could take advantage of the appreciation in the public markets. But there is trading, to your point. Databricks has a very robust secondary market where investors, early employees, folks are seeking liquidity. And what we managed to do is go out into the secondary market, partner with really critical data providers and say, hey, what if we were to create almost like an industry standard SIP? If we were to collate most of the data in these more liquid secondary names and create something that could benefit everybody through more transparency and ultimately provide more volume and liquidity to the people seeking it while this comes.
It's interesting, David, is because I live in Silicon Valley, I've been there 26 years, and I've seen the VCs transform from the club to now basically an industry, an asset class as it always has been. But it's different now because if you're a strong VC like a Sequoia or A16Z, they make their money on their winners, but they also have limited partners that they have to serve. They have investors. And so you can lock in gains and then bring some liquidity portion of the pool to retail through what you guys are thinking. So that's definitely happening. We see that for sure. The problem is that I'd love to bet on that next magnificent private seven.
Right.
Who are they? One, and how do I get in? How do you guys figure this out? Do you just hit the books, hit the street, pound the pavement, knock on doors, do some detective work? I mean, you have to go get the data. Take us through that process, because this is an opportunity on all levels of the ecosystem to kind of take that VC model where it's already happening, standardize it.
Yeah.
They love the liquidity. The limited partners love the returns.
Right.
They can roll the dice and play with basically house money once they lock in their returns.
Right. So you do have to effectively do some kind of data canvassing, to your point, knocking on the doors. We believe, however, pretty firmly that existing experts, people who are best at finding alpha in venture, are going to continue to serve a really important piece of the ecosystem. Right? So A16Z, Sequoia founders, et cetera, they are finding the winners. And the risk one is taking as an LP into those funds is, commensurate with the return they're providing. There is no solution in market today that says, okay, well, once the winners are identified, am I willing to de-risk my return a little bit, but still bet on something pre-IPO? And that is really what we're providing.
So you guys are bringing data to the table.
Exactly.
I mean, right now we take a lot of phone calls. Our CUBE research team, which is we're all over Databricks and Snowflake, like a blank. Obviously, Snowflake's public; it's a little easier. But we have inside baseball on all the Databricks activity, and we cover open table formats. We understand the governance layers that are changing. We see the data lake stuff evolving. So we get calls all the time, even before their last funding. Their valuations were trading much lower than their next round of funding, which that valuation was less predicated on real valuation, but they just wanted to get a position. So we pegged their valuation at a certain number based on what we knew.
Right.
But the funding triggers that next valuation.
Right.
Which, again, how perfect information is that? So again, these are dynamics.
Right. Well, this is why the secondary market is the best driver of real value, because you have insiders, you have investors, you have, the C-suites of these companies looking for liquidity at levels that they know they can get with perfect information. So when we're coming to the problem without perfect information, our solution is, well, find the people who have the information. Where are they pegging the value? Let's go collect those values and create a unified price from it.
Dave, what's interesting is that, the old model, it's like old way, new ways emerge, especially AI. We talk about AI all the time here this week in the CUBE Media Week. But the old way was you had industry analysts. We have a group of industry analysts. We know all that. We call balls of strike, connect dots. But then the financial analyst market was a completely different animal.
Right.
They were interested in what's going on in the market. How do you see those worlds changing? Are they collapsing together? Because in a way, the industry analysts were the ones tracking the privates probably more deeply, because there's things like product roadmap was important, sales revenue, what's going on with market share. The financial analysts were more on earnings, what's the forecast for the guidance. Now you see kind of like a intersection at the nexus of what industry analysts do and financial analysts, never mind the work you did at Goldman and all the people that are tracking this anyway.
Sure.
What's your vision on this? Because this is not going away.
No. We think that in terms of research capability afforded by index products like the one we built with ICE, we'll probably lean more toward industry analysis, because we're, again, never going to have perfect information, right? Until you're on the cap tables of these businesses. And frankly, even if you're on the cap table of these businesses, sometimes you don't have information rights. You're not going to be able to get the type of financial data that a financial analyst really needs to do their job. That said, you can get a lot more granular with data in market today, such as the data we've used to create our index, like where these names are trading, where peers in privates, not publics, are trading, what the primary round of a CoreWeave might portend for an AI software company like Anthropic, et cetera, and use that granular pricing information about where these assets are actually moving in between primary rounds to say, okay, now I can delineate trend information for a specific subsector in privates. I can delineate, future growth potential for, prospective IPO in terms of where something's trading at a discount or premium to that hypothetical. And that is going to empower industry analysts with a lot more data to be able to move forward in the asset lifecycle and actually start making.
I'm already salivating. I want that data. Let's get to do a deal. No, but this is important because you're connecting dots and you're putting the puzzle together at the same time. Some of the best financial analysts I know that are operating today, and the industry analysts, frankly, it's puzzle pieces.
Right.
You're constantly collecting. It's like the puzzle. You get the corners. Now I got, what's this color? It looks like it can fit anywhere. You have to go get the puzzle pieces. You do have to do a little detective work and get that data, because the information rights aren't there, like as you mentioned.
No. And candidly, that was really the biggest hurdle to creating our index, right? So in order to create something reputable, the pricing needs to be institutional grade, needs to be trusted. And a lot of that comes from working with an index administrator like ICE and having a brand of the NYSE associated with an equity index. But a lot of it also comes from our data partners. And we really work with best in industry to make sure that the secondary data we're collecting on these names is accurate, is not duped, and is institutionally representative, right? There are folks out there, putting out asks for $5,000 of, megacorns, and that really shouldn't move price. And it takes a really discerning eye and a discerning model to say, what are the trades, what are the bids and asks that are relevant in these markets, and how is that actually informing the data, to your point earlier, that could really create concrete analysis about where this should be valued.
Let's go through some of the work you've done. Take us through the privates. How would you rank them up? What's the current index look like? Can you share any data around who you're tracking, who's looking good? What are some of the data? What does the standings look like? Is there a standings? I mean, how do you guys report? Take us through some of that.
There are standings. In order to get the full constituent list, you would have to purchase it through, ICE data indices. However, I'm happy.
You're a little tease.
That's all right. I'm happy to give it to you.
Who's trending up?
So right now, the index is up 26% year over year. And a lot of that has to do with really quality years from SpaceX, OpenAI, and some other index names. So at the beginning of the year, for context, SpaceX was our number one constituent. Stripe was number two. OpenAI, with their recent primary announcement, has overtaken Stripe as the number two. And that really speaks to, when you look down indexed in terms of other names like Scale AI, Anthropic, Hugging Face, et cetera, AI's explosion. The fervor in public markets for folks like NVIDIA is translating into similar fervor for folks in private markets like CoreWeave. And we've seen that in the appreciation.
Dave, I can appreciate what the conference room meetings are like when you got the comps so divergent. You got the public comps, high velocity volume trading, privates, you're squinting through the data, you're connecting the dots. What's that like? Take us through a day in the life of what you guys do. Give us a peek behind the curtain.
So we are as algorithmic as possible, to be totally candid. And that's by design, right? Nobody wants my opinion, apart from maybe you during this interview, where a specific name is going. We want the market's opinion. We developed a methodology with ICE data indices to be able to ingest this information as uniformly, as systematically, and as candidly hands-off as possible, right? So every day we receive pricing information. That can be bids and asks, that can be trades, that can be other index-like prices from data providers who are similarly tracking these assets. We collate all of that, put it through our proprietary model, make sure that we're running our dedupe checks, quality checks, et cetera. That then gets sent to ICE, and they are the ones who publish the price. So
great for ICE. They're good at that.
They're very good at that.
All right, so what's the journey been like? I mean, obviously you're navigating through a new area. You're on the front edge of the power wave that's going on with trading, technology, algorithms. You got AI, I'm sure, going on under the covers. Agents will play a big role in identifying some scale. What's the tech look like for you guys? How you think about augmenting the work you're doing?
We are. And so what we've really spent the last 2.5 years building, apart from a network of data providers to create something institutional grade and the technology apparatus to strike these prices for an index administrator like ICE, is creating something that can spit out new indices, new insights, and new data on an ongoing basis. So today we have the Marquee Index, which tracks the 50 largest. Think of it as our S&P. Tomorrow we can get even more specific. We can go into sectors, right? We're thinking of a unicorn index, a unicorn AI index, right? To focus on really the top performers over the last year because of AI's resurgence. We're looking at a unicorn health tech index, a unicorn consumer goods index. And no matter really how you slice and dice it, we now have the technology platform to be able to do that repeatably and quickly. So we'll go where the consumer.
I mean, we always constantly evaluating kind of like some of the dynamics around costs, CapEx costs, OpEx costs with revenue. Obviously, everyone's trying to keep the red line below the black line in terms of revenue profit, but we know you got to invest a lot on CapEx for some of these bigger players. At some point, that's have to cross. Costs are huge, so managing the cost data is huge, and then looking at returns on the top line become huge.
Yes,
that's an art and a science.
It is an art and a science. The profitability flip, right? And when to do that for these companies, I think particularly in the wake of 2021 has become a lot more prescient. We saw capital markets dry up in the late stage in terms of new primary rounds for companies that quite candidly were fairly overvalued and weren't proving to their investors that they could flip that switch. And frankly, we saw that in the index.
Yeah.
We dated it back to 2021. If you were to have purchased it at the height of the last funding round valuation bubble, you would have been down 40%. But that also presents opportunity because that was left in the index. Quality companies who are focusing on profitability and their investors have taken.
David, the number one question I get a lot, because I've been through many waves of innovation, is are we in a bubble? And I take the premise that we're in a bubble, hype for sure, but not like the dot-com bubble, because unlike the dot-com bubble, there was no underlying catalyst for accelerated growth. The PC revolution, when Wintel was the big dominant, Windows and Intel, they were constantly introducing more processors, and PCs got smaller, faster, cheaper. The Moore's Law on Intel side, and Windows on the system software and Office Suite app side also was innovating in terms of capability. So I think there won't be a pop. Maybe a little air might come out of it, but at the end of the day, you have an underlying intrinsic trend line that says, hey, the infrastructure is getting faster. That's enabling apps to be smarter. So it looks more like the PC server revolution than it does the dot-com bubble. But from a user experience standpoint, it looks like the dot-com bubble. But I think the tech is clear that in that super cycle, the first that 10 years of wealth creation had really nothing to do with profit. Look at Amazon. They had never showed a profit, but they dominated the sector, became a leader. If you go from 86 to 96, that 10-year super cycle, you went from proprietary systems, mini computers and mainframes, to open systems. In that 10 years, from 86 to 96, Cisco's only 2 years old. They became the dominant player in routing and switching. First routing, then switching. So I think, as an investor, I think the privates are an interesting bet, because what's going to come out of this private wave is that trend. Ignore the cost side. Will they be the leader, like a Cisco or someone else on that cycle, or in Windows and Intel? I think, Intel, obviously NVIDIA is a big player, Broadcom on the chip side are two monsters that are going to accelerate that piece. But all the Gen AI, it's early innings still on that piece. So everyone gets hung up in the old dogma. Well, that's cost. And even VCs I talked to, like, well, it's overvalued. I mean, if Perplexity goes out at $8 billion, you could have gotten in at $2 billion. That's a nice step up.
So it's like a 4X.
But people tend to, on old school VC investment, get shut. Oh, it's way overvalued. No, there's no way they're going to adjust whether it's, but it's a super cycle. I mean, I love the term super. Some people hate it. I think it's a great name, because in a 10-year span, everything flips. And the winners are established in the first 5 years. That's generally the principle.
I think with respect to the broader super cycle and privates and how they're different, particularly from publics, to your point, Gen AI is really still entirely in a private way, The companies that are going to lead the future from an infrastructure standpoint, in my view, are also largely still private. And even if they're not necessarily the next NVIDIA, they're certainly acquisition targets for NVIDIA, So if I'm a Cerebras, for example, and I have proven technology that can create with 10x less energy the same output from an LLM timing and training perspective as an existing top-of-the-line NVIDIA GPU, that is very, very attractive to existing chipset makers. So if you are seeking value as an investor, you're going to find in the public markets, but they're always going to be a bit more constrained than privates. There is a ton, and we are very early innings here, to your point, but there is a ton to be gained.
And more coming.
That's right.
David, thanks for coming on theCUBE. What's next for you guys? Put a plug in for OpenVC. What are you looking to do? Are you looking to hire? What's next?
We're always looking to hire. We launched that marquee headline index, the 50 largest U.S. unicorns tracked on a daily basis with ICE, and New York Stock Exchange Open Venture Capital Unicorn Index. We're seeking to launch further indices next year, and fairly shortly thereafter, we'll hope you'll see a fund product that will ultimately achieve our core goal, which is introducing new investors, retail, institutional with fee and liquidity constraints into an asset class that, let's be honest, is where most of the innovation is happening.
Final question. What's the coolest thing you're working on right now that you can share?
That I can share. We are working on a way to create real-time custom indices. So imagine you like the unicorn index, but you want to slice it and dice it your way. We can create something bespoke for you, and that would enable specific baskets that investors could use to value existing portfolios or ultimately create an entirely new product for themselves.
Dave Vellante, my business partner, co-host of theCUBE, has a great expression, slicing the salami. And that's what people want.
That's right.
Thanks for coming on theCUBE. Appreciate it.
Great.
All right. All right, we are here. This is theCUBE Studios here on the East Coast at the NYSE. This is our East Coast access point. New York and Silicon Valley now connected with our studios. Of course, we cover events. We're in Munich right now for a great event there. Salona's, of course. UiPath is in Vegas. A lot going on. And then bringing all the action from Silicon Valley to Wall Street. Wall-to-wall coverage on Wall Street. I'm John Furrier, your host of theCUBE. Thanks for watching.